What? Lower your credit score just to get a better interest rate? Is that really true? Yes, it is, but what you don't know can hurt you, okay? And in this segment, we're going to go over exactly what you need to know to make the best financial decision you can make for your next loan.
You just became 50% utilization,
Right.
which in that single move would impact your score by about 25 to 30 points per credit repository.
Don't forget to hit subscribe, and I can bring you all kind of great information in the future. All right, so without further ado, I want to introduce you to Dan Freshley. He's one of the top loan officers in the country. He's with USA Mortgage, and he's a veteran of 23 years
23 years.
in the loan industry. How you doing, Dan?
I'm doing great, Patty. Thanks for having me today.
Well, I want you to tell us a little bit about yourself, and then let us know what in the world is going on here.
So a little bit about me. As you shared, I've been in mortgage lending for 23 years. I focus primarily on the Eastern Seaboard from about the Mason-Dixon line south. I sit in the metropolitan Washington, D.C. area. I'm a race Floridian, so I've got clients and real estate partners from that market, and a relatively robust book of business and previous clients of just about 600. I've been servicing them and their families for most of those 23 years. So, it's a great business. You asked a question about what is going on.
Yeah, have you ever seen anything like this? Lowering the credit score to get a better interest rate? That's mind-blowing to me. Never seen that.
So let's talk about that a little bit and kind of help our audience understand a little bit about what that's all about. This is a measure that was created by the Federal Housing Finance Administration, and it's intended to kind of level a playing field for consumers that have less quality credit scores as compared to those with higher credit scores, which immediately cries maybe a little bit of inequity or possibly even a little capitalism in some people's minds. Not that we want to go down the political conversation here, but there's a lot of misconceptions about this program and what it could mean. So effectively, beginning May the 1st of 2023, a program implemented by the current administration to Freddie Mac and Fannie Mae. And if the audience doesn't know, they are the government mortgage servicing entities that fund mortgage capital for the mortgage industry. Banks, independent mortgage companies, and mortgage brokers alike sell their loans after they've been underwritten back to Freddie Mac and Fannie Mae. They are two of the many entities that are available to create capital and liquidity so they can continue investing in additional properties. These programs are intended to, as I shared earlier, create a little bit of parity, equality in the markets. But there's a bunch of misconceptions about what they mean, how they can impact people, and ultimately where, they kind of intersect with logic.
Right.
So for the longest amount of time, every mortgage that's ever been written for probably the last 14 or 15 years has had a component that was built into the interest rate that is considered a risk-based pricing component. And risk-based pricing is exactly what it implies.
Right.
It says the consumer with a higher credit score should, because they've got a fundamentally proven track record, get a lower interest rate than the consumer with a lower credit score. Seems logical, doesn't it?
Right.
This new measure counters that some. There are other components that go into interest rate, like the percentage of loan to value, meaning how much do you borrow relative to what a property is worth, is one of the factors. There's different risk associated with, for example, a condominium, which is a residence that's part of an association, as compared to a single family dwelling. So there's a number of components there that go together to create those levels of risk, as Freddie Mac and Fannie Mae consider them, relative to pricing. And what's now happened with this new measure is it's added an additional layer of risk for even the consumer with a higher credit score to offset the risk of a consumer with a lower credit score.
It's funny too, because, in the past or even now, if somebody has a lower credit score, usually we set them up with an FHA loan. And this doesn't even apply to those type loans, which is another crazy thing.
That is correct. FHA, VA, and USDA falls outside of the guidance of the Federal Housing Finance Administration, and these components do not apply to those loans as they do to the ones that are what we're traditionally going to call conventional or conforming, that get sold to Freddie Mac and Fannie Mae.
Okay, so for the average person getting a loan that, doesn't really understand all this, but it sees the numbers and says, hey, I'm just going to be late on my credit, on my credit card, and let's lower the credit score so that I can get a better interest rate on this home that I'm buying. There's some dangers in doing that, right?
Yes, there is.
Okay.
So although in theory that could help them qualify for a lower interest rate and or the cost associated with an interest rate, which, we could talk about either later in today's call or at another time as we do this series to try and better help educate consumers. But there can be a very adverse effect to allowing your credit score to go down for the purpose of trying to manipulate, if you will, how this program can impact interest rates.
Right.
For example, if you were to, the average consumer has somewhere between 4 and 8 or 9, depending upon the study, credit cards that may or may not be active. As a general rule, consumers in America utilize credit for a lot of different reasons. Some of them pay off a balance every single month. Others pay significantly more than a minimum payment. Some, unfortunately, get into a spot where they can only afford minimum payment due to a number of different factors. But if you had 4 to 8 credit cards, and let's say, just for a simple example as a baseline, at the point in time that those cards were issued to you over the course of a number of years, if you had, say, 8 cards and a 720 FICO score, the middle of the 3 credit repositories, Equifax, TransUnion, or Experian, for those that don't know, the 3 different major credit repositories, if you had 6 or even 8 cards and a 720 FICO, and you decided you wanted to go from a renter to a homeowner and recognize that the impact of this new program that was implemented would actually, air quotes, reward you for a lower credit score, you could actually significantly jeopardize your credit score by allowing it to get worse for the purpose of improving an interest rate on a mortgage. Here's what I mean by that. Credit agencies and those that extend things like cards routinely monitor credit scores of the cardholders that they have. Mm-hmm. Well, if you had a 720 FICO score and a Visa or a MasterCard issuer gave you a card with a $2,000 limit, and you owed, for example, $500 on your card of that $2,000 limit, you're at approximately 25% utilization. Your score goes down to 680 versus 720 for the purpose of trying to help yourself get a lower interest rate. Mm-hmm. If that credit card issuer were to monitor your card and see your score go down, you change their level of risk, which would routinely see that card issuer reduce your credit line because you're now a greater risk. And let's say they took your line from $2,000 to $1,000 because your score went from 720 to 680.
Right.
In that simple measure, they just reduced your line by 50%, and now your card utilization, $500, is against the $2,000 line, which was 25%, has now become $500 against a $1,000 line. You just became 50% utilization,
right?
Which in that single move would impact your score by about 25 to 30 points per credit repository for lowering your credit score to try and get a lower interest rate. Now you're going to lower it even further as a result of the risk associated with that single card.
Yep. And I don't think that's something that the average home buyer would think about. I mean, they're buying this beautiful home. They're getting a better interest rate because their score is lower, but now they can't afford the furniture because they don't have any credit, right?
Exactly. And, it creates a negative effect because the intent being, I want to try and take advantage of this lower opportunity in the mortgage space, actually hurts them in every other aspect of their credit profile. At the end of the day, no matter what an interest rate is on a mortgage at the time in which somebody closes on their property, smart mortgage bankers, I put myself in that category, I'm going to try and manage that mortgage for that client. Right. They're going to hear from me regularly, and we're going to share with them that in October of 2024, and I'm just using an arbitrary example, interest rates have gone from the 6.5% that you closed on your mortgage to 5.25%, and now you can refinance that $400,000 mortgage with a 1% interest rate reduction. You're going to see about a $350 reduction in your payment. So we want to manage your mortgage for you for the long term. So I guess if there's a moral to the story of what we're talking about here in this newest component that's been added, it's don't jeopardize a good credit profile for a short-term win that can turn into a long-term loss. If your mortgage banker is doing their job, they're going to manage your mortgage for you and advise you of when the opportunity to improve that mortgage exists. And we've all seen the ebb and flow of the interest rate market. They'll change. We've seen a meteoric rise in fiscal policy from the Federal Reserve that's driven rates up to try and, kind of slow down the impact of inflation and or the potential for recession. But sooner or later, that's going to taper off and it's going to go back the other direction. And, we can't forecast when that time will be. It might be 6 months from now. It might be a year from now. It might be 18 months from now, whatever that window will be. There will always be an opportunity for folks with good credit to improve upon their situation and take advantage of a reduction in interest rates. So it's not the most important decision in the overall factor that gets made today.
And, for those people thinking, well, I don't want to refinance later, if they buy smart and their home appreciates, in the next year and a half, many times they can roll the cost of refinancing that loan into the loan itself, correct? So they go in and sign the paperwork and get a lower interest rate and boom, 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 they're done.
You bring up a great point there. We like to share, and it's a bit of a play on words, but it makes a lot of sense to most consumers when they think about it. We like to share the concept that it's the same house. Why would you want to pay more for it every month than you have to? And the reality to that is your housing expense is a portion of your budget. So in this example we used a moment ago, $400,000 mortgage that gets reduced by slightly over a 1% interest rate reduction could save a consumer $340, $50, $60 per month.
Right.
Well, at 300 a month, 12 times, that's $3,600, right? If you take your average tenure in a property, which is about 8.5 or so years, has been the kind of the historical number. If you can save $3,600 a month for 8.5 years, you've just saved nearly $40,000 to live in the same house, right? So that saying, it's the same house, why would you want to pay more for it every month than you have to, can be very appropriate. You can reduce your mortgage payment by $300 plus per month, and it costs, call it $3,000 in closing related cost, fees, appraisal, whatever it may be. You recover that in less than a year, right? So, you can really benefit economically by taking advantage of refinancing and lowering your interest rate and overall monthly payment. By taking advantage of rate reductions when they become available.
You're certainly a numbers guy, Dan. I'll give you that. I mean, you know your stuff. And I appreciate you bringing up all these great points. I think that you've given food for thought to a lot of these home buyers out there that are thinking about ruining their credit just to get a better interest rate. I mean, that would be, not a smart thing to do at this point. And, I just really appreciate you coming on and sharing all of your insight in what people need to do.
Well, I appreciate it, Patty. It's been great working with you and your clients in the past, and I look forward to hopefully educating some future clients with this kind of video and sharing ways that we can help them, and using us for the resource that we should be to be able to help them figure out fundamentally what is their best option and how to proceed. So I'll be happy to share. By the way, I'll point it out. People can find my website and find information about this stuff all the time at danfreshly.com. So it's super easy to find, and they can link to me for email there as well. So I'm happy to consult anybody that needs help or information.
And Dan, I'll have your link down below in the description below this YouTube video. And so people will be able to just click on that link and get right to you. Really appreciate you. Have a great day. You people out there, go out and buy yourself a house, and don't forget to subscribe so that we can send you some more great information like this.
Thanks so much. Have a great day. I appreciate you having me on with you.
Thanks, Dan. We'll talk to you later. See you in the next video.